So the first thing that's on my mind and that I've kind of uh, want to get off my chest, if you will, is this misconception that the between the relationship between preferred return and cash on cash. And I know when I talk to a lot of investors or sponsors or potential partners that are maybe less experienced, they make the mistake of assuming that preferred return equals cash on cash projection. And so that is not the case. They don't really have any connection at all. And hopefully, to be honest, hopefully for most of you on this call, this is old news and you already know this, but just in case, because I just wanted to share this, get this recorded and to be able to provide it for people and just fully explain what this is and then what this means. So just to recap, preferred return is a partnership mechanism whereby investors are owed a minimum rate of return before any performance compensation kicks in and there's a profit split, right? So that is a partnership mechanism. It dictates how distributions are prioritized. However, it does not make any implication as to the level of those distributions. So you could say the deal has a 5% preferred return or a 10% preferred return, and it really doesn't say anything about what the deal's projected cash flows are. In order to understand a deal's projected cash flows, you have to look at the cash on cash projections, and you can look at an average cash on cash. You can look at a year over year cash on cash, which is very helpful to look at year one cash on cash, year two, and so on. And understanding also the nuances, this is going a little bit off track, but understanding the nuances of how we're getting to those cash on cash returns. Because you might have a structure where you have interest only debt, and that is maximizing your cash on cash for you, or you might have amortizing loan payments, which are actually reducing your cash flow and maybe actually undersell the true yield potential of the investment. So that's something that actually I think people are going to be seeing more and more of moving forward due to the attractiveness of loan assumptions. And the reason why loan assumptions are so attractive today and moving forward is because last few years we've seen people lock in pretty attractive loan terms. And so now if they're selling the property, the property's loan actually has intrinsic value. So you're going to see more and more loan assumptions, in my opinion, over the next couple of years. And with those loan assumptions, you might be assuming a loan with an attractive interest rate, but actually unattractive amortization schedule. Because if the previous owner has already began amortizing and you're assuming it from there, you might actually pick up the deal with no interest only payments remaining, as well as maybe by the time you assume the loan, you're amortizing at a 28-year schedule, 27-year schedule. So that's really going to eat into your cash flow. So if you're an investor looking at that deal, you might go, oh, wow, well, this deal is not very good because the cash flow is very low. But if you peel back layers, you can understand, oh, actually, the cash flow is lower because there's so much of the debt service going towards amortization, which is principal pay down, which comes back to you in the end. So obviously, as an investor, if you're going to forego cash flows, right, if you're going to accept lower cash flows, you're going to want to see a little bump in your IRR in return, right? Obviously, you don't want to just accept worse cash flows for no reason. So that's kind of how we look at that. So that's a little bit of a digression, but that is when we're talking about preferred returns and cash on cash returns, you really need to focus on your year over year cash on cash projections and kind of separate the two and understand that just because a deal has an 8% preferred return doesn't mean it actually is projecting 8% cash on cash returns. So hopefully that was a softball for everybody, a nice beginner misconception, if you will. Let me know in the chat if I'm on track, I'm off track, if you want me to go back or anything. Otherwise, I'm gonna put a pin in that and move on. So the next topic I wanted to run through is the difference between IRR and ARR. And before I do that, I do plan on sharing my screen today and looking at the model. So if you, as far as the first topic of preferred returns versus cash on cash, if you want me to show that to you in the spreadsheet, just let me know in the chat and I can do that. I think that one's kind of more conceptual, but happy to actually show it in the spreadsheet as well. But this next one I do want to show in the spreadsheet, which is IRR versus AAR. Okay, so Nick wants for us to dive into the spreadsheet, so let's do it. Okay, cool. So this is Madison at Bear Creek. This is a deal that we recently closed a couple weeks ago now. Just your typical value-add multifamily investment. We underwrote this on a 3-year hold. We've got a 7-year bank loan at just under 70% leverage. And we have a plan to renovate all the units. So we have CapEx dollars allocated for that. And everything else is pretty simple. So first, let's go to the summary page, and I'll show you the cash-on-cash projections here. So the cash-on-cash projections here are as follows, right? Year 1, 4.8%, year 2, 5.4%, year 3, 5%. So again, when we're talking about peeling back layers to understand the deal better, for example, I might have an investor who asks, oh, why is year 3 projected cash-on-cash returns lower than year 2? And that's a great question. And that is because of amortization. Amortization kicks in after 2 years in this scenario. So actually, even though our cash on cash goes down in year 3 from year 2, actually the income is improving and we're actually continuing to grow implied cash flows if you assume that amortization piece as going to principal pay down and kind of going towards your implied cash flow. So that's the projected cash on cash returns here. And I'll go to the waterfall tab in a minute and show you how we're getting there. But the preferred return in this deal is an 8% preferred return. So just because we have an 8% pref, like we discussed, doesn't mean that we're necessarily ever going to reach that 8%, right? As you can see here, in this case, we are not projecting 8% projected cash flows at any point. So first we'll go to the, we'll just skip to the waterfall tab. So here's the waterfall, which actually dictates how distributions are prioritized and made throughout the partnership, right? And as we discussed, the preferred return is the priority hurdle number 1, and that is a 8% cumulative and compounding preferred return to investors before there's any subsequent distributions that are made in the waterfall. So our example here, we have an 8% pref, and we use an IRR hurdle, which just means that we actually have a return of capital before we're able to take our sponsor promote. So what that means is our investors earn an 8% compounded preferred return, then receive all their initial investment back, and then we're able to move to the tier 2, which is a 70-30 split, also known as a 30% promote, which is paid to the sponsor, and that goes up to a 15% IRR. So anything between 8% IRR and 15% IRR is going to be shared 70-30 between the investors and the sponsor. And that works its way all the way to 15%. After investors have earned a 15% IRR through the sale distributions, any dollars remaining thereafter are split 50-50, which is that 50% promote in the tier 3. So that's our deal structure. And again, as we saw in the cash flow projections, we're only getting to an average of 5% roughly of cash flows. So you can see that play out in the actual waterfall. I'll zoom in here. The numbers are not super important, the specifics, but just understanding conceptually what's going on here. So what is going on here? So we invested initially $9 million of equity here, for example, and now investors have a capital account collectively of $9 million. So they earn an 8% preferred return on $9 million, which is roughly this number here. This is what they're owed, which is 8% for that 1-year period. However, we're only able to distribute about 5%, which is $430,000. So we have a shortfall here. So again, the preferred return there is there to protect investors. That's their minimum return that they're owed, and it's cumulative and compounding. So any shortfall, as you see here, for example, is accrued and then compounded. And the way that works is, as you can see, we started with a beginning period capital count of about 9 million, and we end that period, which is year one, with a $9.2 million capital account. So actually the investor's capital base, conceptually, again, this doesn't actually happen, it's not like their capital actually is accounted for differently, but as far as the compounding calculation here, their capital base grew, and then it rolls over to year two. And then now their preferred return of 8%, it's the same percentage, 8%, but as you can see, it's slightly larger in year two versus year one because of the compounding factor. Since we added that 300,000 to the capital account, now your unpaid interest is earning interest on itself as an investor, and you're actually owed a higher preferred return in year two, even though the percentages are the same. So we don't have to continue all through the waterfall. I've made a whole hour video on walking through waterfalls before, but this, I just wanted to show the distinction between cash on cash returns and the preferred return structure. And when there's a deficiency, as there is in this example, how is it treated in the preferred return structure? So I'm gonna take a pause there, and my screen is, okay, great. So I'm all set up with the chat. So feel free to keep on putting questions in the chat. This is totally unscripted, and wherever we want to take the conversation, I'm happy to do so. So that was the first point. Now let's quickly cover the second point, which was IRR versus AAR. So what are each of those things, first of all? So first of all, IRR, which is internal rate of return, is it's regarded as really the most sophisticated return metric for alternative investments. And the reason for that is because IRR is capable of taking a lumpy distribution of cash flows and smooth it out into a compounded calculation. So it takes into account the time value of money in order to derive the projection, right? Because if you think about it, in real estate, for example, if you have deal A and it has, to be dramatic, let's say no cash flow for 5 years, then at the end of 5 years, you triple your money. Or you have deal B, which you get a 10% cash on cash for every year. And then in year 5, maybe you double your money, right? So what's a better return, right? Well, you need an IRR calculation to help you understand that. And also, I totally understand that IRR is actually a completely different, very advanced topic on its own. If you want to really drill into the nuances and how IRR treats the reinvestment of cash flows and things like that, it really does get more and more complicated when talking about IRR, which is exactly why a lot of people prefer to use AAR, which is average annualized return. So while there are merits to looking at average annualized return, I do believe it is deficient. And to be more negative, I would also say that those that use AAR use it in such a way to attract less sophisticated investors. And I don't mean that disparagingly, because at the end of the day, you want to speak your investors' language, but AAR is always higher than IRR, because AAR is just a simple average across the hold period. So it doesn't take into account the time value of money. So that's why AAR is always going to be a bit higher. You can see here in our example, we have a 15.9% IRR projected, yet the annualized return, or AAR, average annualized return, is 17.7%. So if you're an unsophisticated investor, if you will, and I'm coming and pitching you a deal and I'm saying, hey, this deal has a 15.9% IRR, you might go, what's IRR? And the guy down the street is pitching me a 17.7% average return. Well, that makes a lot more sense to me. I'll just do the deal with the higher return and the number that makes sense. So that's kind of the drama, if you will, between the two metrics. I think both are, it's funny actually, is with institutional investors, I've had them look at this model and they go, what is this? They're totally confused because they never think in terms of annualized return. This is totally foreign to an institutional investor or someone who is a professional investor. They would just, so I've been asked, like, what is this? Why is this here? This is confusing. Whereas, an accredited investor, a retail investor might go, IRR, that's confusing. it's a lower number and they prefer this. So this, if you're sitting in my seat and you're a sponsor on this call, I've been saying this a lot, and I really do think that this is really important, which is understanding what you're attracting and who you're attracting. Because regardless whether you know it or not, you are niching down in some regard and you're attracting a certain avatar in some regard. And so we kind of accidentally focused our efforts on attracting more sophisticated investors because I guess, we ourselves see ourselves as more sophisticated and we prefer to think in those terms. And so we might miss out on investors who are less sophisticated, but that is just the niche, whether we knew it or not, that we were attracting. So definitely some digressions there, but hopefully that makes sense, breaking down the difference between IRR and AAR. I don't have time, unfortunately, to really drill into the nuances of both of those metrics, in particular IRR, because it is actually, when you unpack it, quite complex. But AAR is pretty simple. You just take the total returns of the deal and then you divide it by the initial investment and divide it by the number of years. And then that's your average annualized return. So if you look at this, for example, if you just take 17.7 and you multiply it by the projected hold period of 3 years, you're going to end up with exactly the equity multiple of 1.53. And the equity multiple is just taking your initial investment and then adding all the cash flows and then adding the sale proceeds. And it's basically the multiple, simply the multiple on your capital. So if you started with 100,000, when all said and done with the deal, you'll end with 153,000. And the annualized return metric is just simply taking that 153,000, taking out the initial investment of 100, and then just looking at the 53, dividing it by 3 for the projected hold period, and that's your annualized return. And again, just to recap, the reason why IRR is lower is because of the time value of money. If you look at what's going on here, you're getting modest cash flows in year 1, modest cash flows in year 2, modest cash flows throughout year 3. Then finally, at the end of year 3, you get your pop and you get your sale and you get your profits. And that's where you make the majority of your investment. So because it's delayed into the future, those cash flows that are earned at the end of year 3 are discounted back to net present value. And you're getting a 15.9% IRR versus your 17.7% annualized return. Okay, I'm gonna see, we have a question here. Does any unpaid cash on cash return also compound as preferred return? Yes. This goes back to our waterfall discussion. And I might have been going too quickly, but if you look at and break down what's going on here, you'll see that the cash on cash distributions are actually less than the preferred return rate. And so you're ending up with a deficiency here, and the delta, or the unpaid preferred return, then accrues to your capital account, which then moves over to the subsequent period, which then compounds because now you're earning interest on that higher capital base. So I know this waterfall concepts can be complex, so I can share with people offline the previous webinar that we did, really walking through it. Hopefully I did a better job of explaining it on that call. Rigo in the chat is asking about yield on cost. That is a fairly broad question. I can define it. We can dive into it. It's one of my favorite metrics, but unfortunately with 10 minutes left, I don't, I can answer something more specific if there is a question there that's more specific.
Right. Rob, maybe if I can jump in here via the audio, that's very much appreciated. Maybe we could deep dive a bit into crystallization mechanics, especially with a cash flowing asset. That would be helpful to understand, and how you would model that out here in this example. I mean, I know it personally from real estate, private equity, ground up developments, where obviously this is kind of helpful. But how do you deal with a standing asset from cashing in from day one? That would be helpful.
Sure. So the model that we have in front of us here is not capable of showing a crystallization. So everything we talk about here would have to be just conceptual. which, I can try my best as far as speaking conceptually. So, just to set the stage, I do think that crystallizations really are best suited for development deals. And it sounds like that's been your experience as well. So let's just keep it. But it's really the same in a value add deal. It's just not as dramatic. So let's just spend 2 minutes on that because I want to cover some other things and there's some other good questions in the chat.
Right.
So if you buy a value add deal and let's say the sponsor, let's just say, I like to use an example where the sponsor invests 10% of the equity. So let's say the sponsor invested $1 million into the deal. Their capital partner invested 9 million. So the total capital is 10 million. And let's say the project is worth 20 million, right? Well, let's say they lock in a long-term loan that they just can't get out of and they can't sell the property, right? Usually that's kind of the setup for a crystallization. And what you would do, let's say after the sponsor implements their value add plan, let's just be dramatic here. Well, let's not be too dramatic. Let's say that, let's say the deal was worth 20 million before the business plan, then the business plan was implemented, and now the deal's worth 30 million. The sponsor is going to be incentivized to sell because they've done a great job. They've created $10 million of equity value, and they want their, let's say, 30% promote. So the sponsor wants $3 million in their pocket, and the only way they can get it is by selling the asset. But if the capital partner doesn't want to sell, the capital partner says, no, I love this deal. I love the location. I think there's more growth to be had. Let's hold it long term. They're going to butt heads because the capital wants in, the sponsor wants to earn their $3 million. So what do? You crystallize the promote. And what that means is you actually run the project through a hypothetical sales scenario where all parties involved agree to a price. Let's say that price is 30 million, where that sponsor is owed $3 million. And instead of, it's a hypothetical sale. So you actually don't have any sale proceeds to distribute. So what you distribute instead is ownership in the deal. So that sponsor originally invested $1 million and they had 10% of the deal. Now you crystallize the promote and you take that $3 million that they would have earned on the sale and you add it to their capital account. So now the sponsor actually is now a 40% owner in the deal. They actually have $4 million in their capital account that they now have credit for. The investor gets squeezed down from the original 9 down to 6 million. And moving forward in that 60-40 ownership, they are what is called pari passu, which means there's no more promote, there's no more preferred return. So each entity or individuals, the $6 million investor and the $4 million sponsor, now just earn equally pro rata whatever distributions are ahead for them in the deal. So that is what a crystallization is, and I managed to do that in 3 minutes.
One last question, but they only get paid out once the project is really being sold. There's no distribution in between.
In that crystallization scenario that we just walked through, no dollars was actually distributed, change hands, just ownership percentages were tweaked.
Right.
Now you can do a crystallization in conjunction with a refinance where there is some cash to be played with, right? You could refi, but that gets tricky because you just have to make sure that the legal docs are written in such a way to actually allow for cash from the refi to be distributed in accordance with a crystallization rather than the waterfall going in, which would be, prioritizing the investor's return of capital.
Right.
So a little bit complicated, but yeah, no, I appreciate you asking about that. I want to really read Greg's question here. How come the sponsor is getting a distribution even though the preferred return hurdle isn't being hit with cash flow from the project? The capital account is growing instead. So there's definitely some misunderstandings here. I'll re-share my screen really quick, and I'll make this easier to understand. So for the purposes of this explanation, I'm going to set the sponsor capital account to 0. So let's say the sponsor invested nothing in this deal, right? Nothing. So let's go back to our waterfall. So as you can see, the LP, same scenario, right? They're owed a preferred return. There's a deficiency. It accrues to the subsequent pay period. And then there's accruing and compounding interest that is owed and paid, but it finally gets caught up upon sale where the minimum 8% cumulative and compounded preferred return / IRR is met. So you could see in this pay period, which is the preferred return period, the sponsor makes nothing. Right? When you go to tier 2, after that 8% return is satisfied, this works its way up to a 15% IRR. In this case, finally, you do see that the sponsor does make $1 million in promote in this scenario. And actually, there's a little bit of cash. There's $700,000 of equity of distributions on top of a 15% IRR. So investors are happy they've made their 15% IRR, and there's still yet another $700,000 left to distribute. So what happens with that? Well, in accordance with the waterfall, the remaining is 50-50 split. So it's really simple, right? We just take the remaining cash flow here and we split it 50-50. And so half of that goes to the sponsor. So in the end, the sponsor made the 350,000 in tier 3, as well as the $1,065,000 in tier 2, for a total sponsor promote of 1.4 million. So hopefully that makes more sense as far as what you're asking, Greg. The sponsor in this example structure is not making any money, not getting any distributions from the waterfall in this example. Cool, very cool.
Sorry, Rob, one very quick question. But in this case, as we have 0% ownership on the LP, on the GP side, the GP, the sponsor, shouldn't get any distributions, right? Because he has no capital commitment.
That's correct. So you could see here, there is nothing being paid to the sponsor. The only thing that is being paid to the sponsor is their promote, right? So
even though he
is
has no equity
yes.
contribution.
Yes, that's the literal definition. Well, I can't say the literal definition, but that is the definition of promote, which is basically an individual in a partnership that gets credit for, for performance, gets credit for distributions without having any capital committed. But usually,
Okay.
obviously, deals typically have a balance. Usually a sponsor invests so that they earn a return, just like their investor. And then on top of that, they also earn their promote. So they're really two separate things. The sponsor's investment and their promote are two separate things. And again, it's another situation where they don't have really any correlation. If the sponsor does invest, they're just earning LP returns. They're investing at the same terms as the LPs.
Right.
So their investment is completely separate from their promote interest.
True. Yeah. Maybe I misunderstand it, because normally when the sponsor doesn't have any equity contribution, or then I'm a single shareholder, meaning the LP. So the LP gets his complete pref plus any sort of tiers whatsoever. But basically the tiers and the waterfall comes obsolete if I don't have a sponsor in my deal, because then I have a single shareholder, right?
Yeah, so I mean, unfortunately, I don't have time to go more into that, but I short answer is you're wrong about that. Because actually the promote is, I mean, everyone's deal structure is different, but the promote would actually be accounted for through a different entity. It'd be at the manager level entity. So the manager doesn't even need to be an owner to be basically a non-member manager in a certain situation, right? Where they are receiving distributions from the main investment entity. And unfortunately, it's 2:31 on my end, and I'm running late to my next thing. But I really wanted to share. No, it's not your fault. It's my fault for getting double booked here. Normally this goes for an hour, as you can see why, because we like to go on and on.
Right.
But Jack is asking, will this be recorded? This is always recorded, absolutely. So by registering for this, you're automatically going to get a follow-up email with the recording. And let me just sneak in one more concept, which I think might be valuable. I had a few more, but just one more, which is asset management fees. And are they charged on revenue or are they charged on equity? And the right answer is it depends. It just depends on the deal you're in. So there's not necessarily a right or wrong, but I just want to give an explanation. So see if I can do this quickly and elegantly. So in a normal scenario, asset management fees are based on revenue. So if we have, for example, $2.3 million of revenue, right, and we charge 2% on that, that's going to be about a $46,000 fee. Now, some other deal structures might charge a fee based on equity. as an ongoing asset management fee. So in this scenario, if we have $10 million of equity, and let's say it's only a 1% asset management fee, that turns out to be a $100,000 fee instead of the $46,000 fee. So this is actually quite interesting because the asset management fee at 2% based on revenue is actually half as much as the asset management fee when it's based on equity at 1%. This is why it's really important for you to actually peel back the layers of your deal and understand what the terms are and understand what the actual cost implications and to underwrite it accordingly. The only nuance I can add here before I jump off is that this relationship is exacerbated with lower leverage, right? The more equity you have in a deal related to the total deal size, the bigger an equity-based asset management fee is going to be. Whereas let's say we're buying this same $20 million deal, but we've got it levered up, you might only need $5 million of equity. So a 1% asset management fee on 5 million would actually only be 50,000, which would be the same as a 2% asset management fee on revenue. So in this new world that we're in, where leverage is lower, an asset management fee based on equity is going to be higher than in other circumstances. So thank you very much for joining me for what turned out to be a speed round. Hope to see you guys next time where we can be on for a whole hour. Thank you guys very much for joining and being on time. Love to see that there was 40 people here plus today. So yeah, again, thanks so much. And feel free to reach out if you ever want to chat about upcoming deals that we're working on, partnerships, or whatever is on your mind. Happy holidays.